Good morning, everybody, and welcome to the latest edition of Coffee with Counterpoint. Thank you for taking the time to join us today. We will be sharing some thoughts and answering some questions from the audience that they've posted to us. As always, we just want to get some of the housekeeping out of the way. We use GoToWebinar as a platform to host these webinars. What we find is when there's any technical issues, the first thing that usually go is sound. Technical issues meaning bandwidth. So please close all other applications that might be open. And we find that that solves 99% of the problems. Secondly, there's a question box on the right-hand side of your screen. If you have any questions or comments on the statements or the conversations that we're having, please feel free to share that, and we'll be happy to touch on that as we go along. Then thirdly, CPD points. We are in a new cycle. We've been fortunate enough to get one CPD point for each of the previous Coffee with Counterpoint sessions that we've hosted. As there are no presentation slides, we can't request that up front. So we submit the content post the webinar, and it usually takes about 3 weeks to get the approval for those CPD points, after which we send out the certificates. And then just one other point that I want to make mention of: the amalgamation or merger of the Bridge business into Counterpoint was finalized during the course of last week. Once again, we just want to say thank you to all the personnel within Counterpoint at SCI and then on Silica side as well that has made this transition possible and as smooth as it has been. There were 1 or 2 hiccups which was resolved fairly quickly. So we just want to say thank you. And with the amalgamation behind us, we now are in a position where all the various styles and methodologies and philosophies are fall under one umbrella. So we've kind of created, and we are now at what we've been talking about, creating a multi-styled boutique asset manager. And within the stall, we've got the fixed income, we've got payers and growers, we've got quality, and then we've got value. And we're going to ask a question a bit later on to the audience on that. And so we're fortunate enough to have Ian, who falls under the payers and growers stall, and we've got Pitt under the value, and we've got Rayan under the fixed income side of things. And I think most of you will be familiar with Ian and Pitt. And so just some background on Rayan. Rayan is a UC graduate. He did a B Business Science degree and honors in finance. He's also a CFA candidate, and he's got a significant experience in the back and front office of investment management. He started his career at State Street, where he spent roughly 2 years, after which he joined the ECM team, where he spent about 5 years before the amalgamation into Counterpoint. Most importantly, Ryan is becoming a dad in a month and a bit, and we're all looking forward for the start of that new journey of his as well. So Rayan, welcome, and we're certainly looking forward to spending some time with you over the next 50-60 minutes. Interestingly enough, when we send out the invitations to Coffee with Counterpoint, the audience get the opportunity to post some questions and comments. And for the first time since January, when we started Coffee with Counterpoint, we did not get any questions on cryptocurrencies, funnily enough. So I thought I'm going to start today's session off with a poll, just to, and I think this is just for fun, really. And so please take a minute, and we'd love for you to share your view or your feelings on where you are at in that regard. And I'd love to share that afterwards, just to get the conversation going. And after which we'll get into the question side of things. We've got about 15% of people voted, 20. I'm going to give it another 10 or 15 seconds. Right, let's close the poll and share the results. Hopefully it's not too surprising to everybody. I see 28% of people are buying the dip, 47% are sitting tight, and 24% are selling out. Don't know if there are any surprises there to anyone. And so putting the concept of cryptos behind us, I think let's get into the, firstly, I want to say thank you to everybody that have actually posted questions. It makes my job as host way, way, way easier. And so the first question that I want to get into is from Andrew Marcantonis, who asked, why is the South African rand so strong? And what will it take to weaken And are there any signs of slowdown? And I think, Rayan, if you don't mind sharing your views on the SA or on the Rand, and Ian, you're also welcome to chip in should you feel you've got something to contribute. Rayan.
Okay, sure. So I think the question needs a bit of unpacking based on what metric is it strong and what is the reference point. So on the 1st of January 2020, prior to the COVID sell-off, we were at 14 Rand a dollar. We are now marginally under 14 Rand, which is not too far off our fair value. So we use a PPP model, and although PPP is not an exact science, it's highly dependent on the starting point. It provides valuable insight over extended periods of time, as well as at extremes. So COVID causing the latter, when we blew out all the way to 19 Rand last year. So I think the question is more one of momentum rather than valuation. So the Rand has been a strong performer over the last year, having printed 19 Rand following the exodus from South Africa. And we had bonds selling off, our equities market sold off, and people just basically took cash back out of South Africa, and that obviously caused some pressure on the dollar, on the Rand. The Rand was not only the only strong performer last year, you have the Aussie dollar that performed well, Canadian dollar, Nigerian naira. So what these all have in common is they're all commodity-linked currencies. So apart from the commodity strengths, we also boast high relative real yields versus the developing world, and with the real yield differentials compensating you favorably for the carry strategy, it makes sense why the Rand has actually performed well over the last year.
Very interesting comment on the commodity-linked currencies. Sorry, Ian, did you want to add?
Pitt wanted to add.
Yeah.
Was it my apologies?
I think Rand's explained it quite neatly. At the end of the day, the Rand goes where the fundamentals determine it should go, regardless of sentiment. So sentiment drives in the short term, but longer term, it's driven by fundamentals. Those fundamentals are exactly as Rand pointed out: the purchasing power parity (PPP), inflation differentials. If it follows that very closely over time, and what's happened now over the past 6 months is the Rand has gone to what we think is fair value, but now you've got a commodity cycle on the go, and on top of that you have some of the highest interest rates in the world in South Africa, and for yield-seeking investors that's quite attractive. So you got two compounding factors on top of the fundamental issue of its purchasing power parity, which I think could drive it even stronger in the short term. So I think the stars are aligned for a Rand that could go even stronger. It's possible, of course. This is not a forecast. It's a possibility given the fundamentals behind it. I do think that if it were to go stronger, investors should start taking advantage of that by increasing their offshore allocation. As always,
that's a fair comment.
Yeah, I don't think one should have all your eggs in one basket. You shouldn't have all domestic, all offshore. Depending on where the Rand is, when it's very weak like it was last year, I think you want probably a bit more here than you otherwise would have had. And if it were to get to very strong levels relative to its purchasing power parity, which we think is around 1350, then I think you probably want a bit more offshore again. So you got to play it that way. And I think the very important thing is to recognize the sentiment and probably go against the sentiment.
That's a fair comment, Pitt.
I think, Jaco, maybe if I can just add, within the payers and growers cluster, we are now seriously contemplating an allocation to direct offshore, something that we haven't had in our portfolio for a long time. So the last discussion that we had around any possible changes that we would make to the portfolio was around an introduction of, maybe 5 or 10% direct offshore exposure into quality dividend paying and growing businesses, probably in the UK or Europe. They're a little bit cheaper there, but we certainly feel that it now is a good opportunity to take advantage of where the currency is. I think just on a purchasing power parity, just talking about that, we now have lower inflation than the United States. So in theory, our Rand should be appreciating against the dollar, not depreciating.
Fundamentals, yeah. That's very interesting, Ian. So I think we'll certainly have to spend some time talking to the marketplace. I would, if we're considering allocating a direct offshore component to the payers and growth strategies,
it's also about valuations as well, because there are some very attractive valuations in sort of the non-tech space, again, particularly in the UK and Europe, where you can still get dividend yields of 4%, 5%, and 6% on good quality businesses that are likely to grow their earnings above world inflation. And you know, and you've got a rand that is very strong now, so you basically got a lot of tailwinds, for want of a better word, and a really good opportunity to diversify the portfolios.
Yeah. Interesting. I like that. So further to the conversation on the rand, you know, Rand, I want to ask you about the yield curve as well. You know, the current yield curve, your interpretation locally, globally. If you can maybe elaborate on that and give us your perspective on that.
Sure, Yoko. So I think I'll start on the South African front first. What we do is we look at extracting the underlying components of the yield curve through principal component analysis. This is basically just a fancy way of saying decomposition. It is important to note the different drivers of the yield curve. The front is associated with monetary policy, whereas the back is associated with the real economy and economic drivers. So through the decomposition process, the yield curve is pricing in negative short-term real yields, as the average expected short-term nominal rates are deemed to grow slower than the expected inflation. Reinforcing this notion is the stance of the MPC to remain accommodative, thereby allowing inflation to move ahead of policy rates, and this will result in degradation of your purchasing power. So the nominal yield curve is also at its steepest level I've seen over my relatively short lifespan. I've maxed out Bloomberg's history as well and come to the same conclusion. We are being significantly rewarded for taking on additional duration. Longer term bonds maturing 2040 onwards are pricing in an inflation risk premium of nearly 1%. And this is significant given the embedded expectations of inflation priced into the bonds are just shy of 6%. There's adequate room for yield compression on the long end of the curve, so you can get a form of capital appreciation while being paid a very attractive coupon. So on the South African yield curve, I'd favor inflation-linked bonds in the short term to mitigate negative real yields, and fixed rate bonds on the long end of the curve to capture the inflation risk premium. If we move a little bit further to the United States, the US curve differs from that of South Africa, where there's almost little to no term structure there. So you're not being compensated much for going further out on the curve. So while the South African yield curve is steep, the US one is flat. The Fed has consistently reiterated its stance on accommodative policy, currently being priced into the yield curve. And as I've mentioned again, the curve does not indicate term premium, but that of inflation expectations. So the question really comes down to, on the offshore side, is will inflation come back? And inflation is a form of confidence, whether you're willing to spend today and if you know you're going to have money to eat tomorrow, I suppose. Accommodative monetary policy doesn't always result in inflation. We need to look look no further than Japan for this. Money printing as well, in theory, suggests that inflation will come, but this only holds if it's not offset by the velocity of money. So since 1995, the US has increased the supply of dollars fivefold. With the last year, they've probably used the most ink they've ever used. Over this period as well, what has happened is there's not been a sustainable uptick in inflation worth noting. One explanation can be the steady decline of the velocity of money over the same period. So just looking at the velocity of money over two periods, 1960 to 1995, pre-1995 it was flat, ramping up just between 1990 and 1995. The S&P 500 gave you 5.8% annualized. Post 1995, you got 8.4% annualized. So I think perhaps we are getting inflation, but asset price inflation instead of CPI. I don't know. I think the opinion is lower rates for longer.
I don't think that's very different to what most market commentators are saying. You know, I don't know, Ian, if you've got a different view or anything that you'd like to add, maybe on interest rates itself.
Yeah, look, in South Africa, I do think the interest rates bond yields are very attractive as an investment destination. I think our long bond yields are priced at about 10%, with inflation of, I don't know, where 4 to 5%, probably close to 4 than 5. So that's almost 5%, 6% real yield on government bonds. I know there's a lot of fears around the government deficit and, are we not bankrupt and all that sort of thing. But if you look at our fiscal situation, it's probably one of the better situations in the world. The US is running a deficit before borrowing of 19% of GDP. I mean, that's unprecedented. Even the Second World War, that didn't happen. So, at least in relative terms, they're much worse off. Yet our bond yield is sitting at 10%, their bond yield is sitting at 1.5%. So, I think our bonds offer very attractive returns, both in absolute and relative terms. So yeah, I agree with her on there. I take advantage of that term premium that is embedded in our long bond yields.
Absolutely.
I think, Jaco, maybe also just talking to one of the points that Ryan made as well about lower for longer. I think also given the level of indebtedness globally, it's very difficult for governments to fund higher interest rates. And Pitt's talked about it quite a lot about financial repression and the length that governments are going to go to keep interest rates lower. If you're running massive fiscal deficits and you're going to do that for a while still, I don't think there's any, the US is talking about more fiscal stimulus, not less. They are talking about higher taxes in certain areas like technology businesses, but by and large, it's about more stimulus, not less. And you're going to still have to continue to fund that. And you can't be funding that when your interest rates are at 4 or 5%. You can only fund it when your interest rates are at 1.5% and 2%. The problem with South Africa is that we're trying to fund, yes, a smaller deficit, but with much, much higher interest rates. If our interest rates did come down to sort of 8% or 7%, then it becomes much easier for our government to fund the deficit. And I think the other thing is if we are, and I don't say we are, so don't quote me on this, but if we are in a commodity super cycle, then that's got to be massively beneficial for the South African fiscus. And we've already seen that take a lot of pressure off our government. We do have some levers we can pull. I think reducing the public sector wage bill it's difficult, but it's doable. We've already seen the president make some changes. The sale of SAA recently is also got to be a positive, because as long as it works, as long as it's sold to the right people who can actually run the business and fund the business, then it takes a lot of pressure off government. The electricity story is another thing that is a massive drain on the fiscus if we can get that sorted out. So there is a lot of room for the government to maneuver if they just make the right policy changes.
I agree. Look, Ian, I can't agree more. Thank you for that, Ryan. And Ian and Pitt, another question from Tom Robbins was, he wanted to know if big tech companies, given what has happened recently in markets, are currently offering value. He specifically said, is it too risky to invest in tech stocks, or has it turned into a buying opportunity? And I'd like to pose it to Pitt, to share your views maybe on big tech at present.
Yeah, I don't think investing in any type of stock is risky per se, whether it be tech or motor vehicles or gold or construction, or it depends on the price you pay for the stream of earnings you receive. And right now, I do think that the market is discounting strong growth for a very long time from some of these bigger tech companies. Because I think what's happened through the pandemic is a lot of the spending on tech has been pulled forward into the present, showing massive growth rates in the here and now. And what the odds are those sort of growth rates continue for a long time going forward, I guess it's quite low. It's possible, but quite low. So I do think that the big tech companies, Microsoft and a P of, I don't know where that, P of 40. Some of the other ones, Facebook's probably more reasonable. By and large, they're probably better investments than they were a year ago. Are they fantastic investments at this point in time? No, I don't think so. And as a value investor, I think there's so much really good value around that one doesn't even need to go there. There are companies trading at very low multiples, high quality business trading at very low multiples, both in South Africa, Europe, UK, less so in America, Asia. You get a lot of those sort of companies that one doesn't even have to go to the high-tech companies to get good returns. They are available elsewhere. And given the inflation outlook, if the other reason, let's take a step back, why were tech companies quite highly valued? Because growth was scarce. There wasn't a lot of growth around. So if the market identifies something is growing, they put a high multiple on it. I think if you get inflation, then growth will be a lot less scarce. Growth will actually be quite common. And when I talk about growth, nominal growth, real growth plus inflation is nominal growth. If there's lots of nominal growth around, then I think the scarcity premium for tech companies' growth ability to grow might go away. So I don't think one should ignore those stocks, but should they make up a huge part of your portfolio? I don't think so. I think it's too risky still. Ian, you might have some comment on that.
Yeah, I mean, I think also the discount rate that you apply to those cash flows is important, because for the growth stocks where it's sort of 40 years of very high growth or 30 years of very high growth that you're discounting back at very low rates, that the low rate environment is clearly benefiting those businesses. Now, I mean, we do think that rates stay lower for longer, but there is a risk that inflation isn't just transitory in the States, that there's sort of 4 and 5% readings that we see actually last a lot longer, and that will start to put pressure on the Fed. And despite the fact that countries need lower interest rates, central banks may actually be forced to cool the rates of inflation, and that could have a significant and negative impact on the valuation of these growth stocks. It's certainly not something that we are sort of predicting, but it is certainly one of the risks that we see from tech valuations. I think the other thing that I have noticed is that a lot of the new technology is not as difficult to replicate. In other words, the barriers to entry in many of the new businesses, like this, for example, like webinars. There are so many different competing technologies, and Google has now announced they're going to step up to challenge Microsoft, and Zoom is obviously challenging in that space. It's different when you think about a business like Amazon. Amazon has created this massive moat around itself, in my opinion, because it has the infrastructure. It's spent a tremendous amount of money and a lot of time acquiring warehouses in the right place, building a fleet of trucks, a fleet of planes, in order to meet the demands placed on it by its customers. So I think a business like Amazon is probably a bit more resilient. It's very difficult to see somebody coming in and taking away market share from Amazon. Although having said that, we do see some of the bricks and mortar retailers expanding their own digital footprints and their own online footprints, and they are actually quite successful because they have loyal customers to start off with, which is something that Amazon didn't have initially. They had to build that customer base, whereas a retailer that's been around for 30 or 40 or 50 years already has that very loyal customer base. But I think the businesses that are producing software or technologies that you just utilize on the internet or through the web or through a browser, even online gaming, I think the barriers to entry there are actually very, very low. Yet the market is pricing these businesses as though they are completely immune to competition. And I think if you look at where graduates are going, most of them are moving into tech. Most of them want to be involved in tech. Think about all of these smaller startup businesses. They're all tech-based businesses. I know they eventually get gobbled up by some of the bigger players, but there is going to be significantly more competition for these businesses. And so to put that sort of massive premium on a business just because it's the #1 player today, I think the risks can be quite high as well.
Interesting, yeah. Agreed. Ran, would you like to add to that? Have you got a strong opinion on that, or do we move on?
No, I'm a fixed income guy. But I think it's important to mention here, obviously, that any of these type of growth businesses are a function of interest rate. I mean, because you are discounting the cash flows. And I think, as Peter has mentioned, in the last year, I mean, cash flows have come forward for a lot of these businesses. So, I mean, it's definitely brought the valuation more in line with where it has been historically. But if there is a risk of hiking rates sometime in the future, I mean, these businesses are going to be the ones that's going to fall first. The only difference is these are established businesses now. So your Amazons, your Microsofts, all those that are considered techie stocks aren't the same techie stocks that were here in 2000. We have cash flows that are now front of the curve and not 10, 20 years out. I mean, we do have the 10-year US yield sitting at what, 1.5. So I mean, you're discounting it basically a very low rate. So you can put anything on and get a decent multiple here of like 30, 40. It seems justifiable just based on the interest rates alone.
I think one also has to be very careful about the law of large numbers. If you go back 10 years and you look at the 10 biggest companies in the world, you go back 20 years, the 10 biggest companies, then in 30 years, the 10 biggest companies, they change the whole time. They don't stay, the 10 biggest companies don't stay the 10 biggest ones forever. Competition attacks the big incumbents. They become just too big to move fast and to continue growing at such high rates. And that's just the way of the market. So I do think that very large companies, just like very large mammals in the past have faced extinction, very large companies face some existential risks as well over time.
That's true. Absolutely.
I mean, I think that is actually important, because not only is it the competition they face, but regulatory risks as well, because governments don't like to see big businesses bullying them and pushing them around. And I think you've got to the point now where individuals like Elon Musk are even bigger than Joe Biden. And that becomes uncomfortable for politicians, because here we go. Here's the comment that's probably going to be quoted. I mean, politicians are egotistical. You think about the job that they do. They're there. I mean, you think about the way in which they operate. They spend 2 years trying to get into office. They then do some work for 2 years and then spend the next 2 years trying to stay in office. I think one of the things that we do see now more so than in the past is a regulatory headwind for some of these very, very big businesses. I mean, the fact that the only area where they're looking to increase taxes is amongst the technology businesses. In China, I mean, yes, it's a very different model. It's a very different political landscape. But there, they're looking to break up these big businesses because they do pose a threat to the government. The government feels threatened by the power and the strength of these companies. They are closer to their customers and consumers than the government is to their constituents, and so that worries them. And as a result of that, the governments will step in. We've had antitrust regulations and anti-monopoly policies for years, but in the United States in particular, those have been very, very loosely applied. I think under Joe Biden, it becomes a much stricter regime, and certainly those big tech companies are going to be at the forefront of ongoing legislative risks.
I agree with that, Ian. I mean, you've seen it with cryptos, with regulation being introduced, etc. And there's quite a lot being written about that, in the recent weeks. And I certainly believe that it does have an impact on the volatility of I don't want to call it an asset class, but it certainly does have an impact on the price and how it's perceived. I want to move on to a next question that we got. Ian, the corporate action in the property sector. I do want us to spend some time on that. I know that there's been quite a bit of corporate action of late. Would you mind elaborating and do we see this continuing? Do we see this unlocking value? What's happening in that space at present?
Yeah, I mean, it's sort of, this is how the property market goes. I mean, you don't have to, it's not just in South Africa. We've had these sort of cycles occur in other markets where eventually the price of publicly traded property companies is so low relative to the replacement value of those portfolios that the private market just looks a lot more attractive. So, if you've got businesses that are trading on 30 and 40% discounts to net asset value, and at the point that the market believes those net asset values, then it makes sense to buy those businesses and to take them private, because immediately that value gets unlocked, because the next time you do a valuation, it's going to be at market related prices, not at the price that the share is representing. And so we've had this on 2 previous occasions in South Africa, and we've had it at least on 3 or 4 previous occasions in the United States, where the public market goes chasing something else, and maybe in this case it's tech, or it's not South Africa, or it's bonds, and so the funding trade are these less sexy, less desirable businesses like property. But eventually it becomes attractive to your private equity market, and they pile in. And I think that's what we're starting to see. It's probably not, it hasn't happened as quickly or in sort of volumes that we would have originally have anticipated. But then I think it comes back to this point around, well, do you believe the net asset values? And if you go and talk to any asset manager, any investor, anybody in South Africa, why aren't those property values so much lower? Retailers are struggling, people aren't shopping in shopping centers, although we've seen a reversal of that trend more recently. I think people have been quite happy to go back into shopping centers. You've still got a lot of people working from home. That technological innovation is not going to change, and so people are questioning whether or not those net asset values are correct. I think on average we've seen about a 15 to 20% reduction in net asset values. People are saying maybe it should have been 30%, but even with that 15 to 20% reduction, you've still got a lot of companies trading on valuations that are 30% below that net asset value, or the share prices are at 30 and 40% discounts. So what we are seeing are investors coming in, offering a price somewhere between the last reported net asset value and the last share price. And for long-suffering shareholders who've sort of whipsawed from very high values to very low values, in maybe some of the less liquid companies, that seems like a good exit. And there are still question marks around, how would that value be unlocked in any other way? And so we've accepted or we've signed irrevocables to accept the R4 offer for Tower. It's in the market. When that offer was initially conceived, the share price was around R2.30. So you've almost doubled the value of your investment, even though the net asset value of Tower is significantly above R4. But there are significant risks in that business. They are doing a development in Cape Town. They're trying to sell residential units at a time that the market is particularly weak. They've got CapEx programs, they've got OpEx programs. There's a lot of cash that the business needs, and it's difficult to raise cash in this market. So and it's not particularly liquid at the time. I mean, that's a yield for investors today of around 8%. We can take the proceeds of that investment and apply that pretty much to any business in the listed property sector today and get a higher yield and still get that 30 or 40% discount to net asset value that we were previously enjoying at Tower. So I certainly don't think we've seen the end of the corporate action. I think we're just at the beginning, but it's certainly going to be a little bit slower than what we've had in the past, because there are still a lot of question marks around the values. The net asset values. But then, if you've got access to capital and you can maybe change the portfolio or do something different with the portfolio, it's probably better in private hands. The big difficulty for the listed property companies today is accessing that capital. They've sort of maxed out their balance sheets. The banks are very reluctant to lend, and the prices are so low that doing an equity raise is dilutionary. And so they are in a slightly more precarious position in terms of trying to change the nature of the portfolio, to make to convert, for example, an office into a residential property, or to future-proof a shopping center, or change, dynamically change the mix and feel of a shopping center. It's a lot easier for a private investor to do it with access to capital.
Good. Pete, you wanted to mention something, or you wanted to add?
Yeah, so for a non-property investor, I look at it in the following way. First of all, as Ian points out, the NAVs might or might not be right. One can debate about that, but I think more importantly, which direction is the NAV going? Is the NAV going up over time in the future, over the next year or 2 or 3 or 4, or is the net asset value going down? And I believe net asset values are facing significant headwinds in terms of negative rental reversions, in terms of valuation parameters, all those sort of things. So that even though some of these companies might be trading at big discounts to NAV, the NAV might be trending towards the share price instead of the share price trending up towards the NAV. So I think one needs to bear that in mind. That's the one thing. And the other thing is, and Ian also touched on this, but I think it's key to understand that historically these companies have been massively poor capital allocators. They raise money from the market at the top of the market to buy properties at very high valuations, and then when the properties ran out, they started buying each other at very high valuations. And now they're sitting with all these cross shareholdings and shareholdings in each other that they can't unwind or find it very difficult to unwind, and they have no access to capital, and rightly so, because they have been such poor allocators of capital. So I think the market, they have to now buckle down and show that they can actually allocate capital rationally. Only then will the access to capital start improving for them, but that will take a while. I think that'll take quite a few years. So I think there's some headwinds still facing the sector. And the last thing is, I think the sector as a relative to the economy is massively overcapitalized. I think I forget the exact numbers. I used to have them, but the area we had in terms of square meters shopping centers per capita is like the highest in the world. For a middle to low income country, that's just ridiculous. So I think the sector as a whole is massively overcapitalized. So there's a couple of headwinds here, and I think one has to bear that in mind before you start taking too big positions in the sector.
I think what's important. Sorry, Ian, go ahead.
Just to add to that, I mean, and that's the reason why our property portfolio that we construct looks so different to the overall market. Yes. We're invested in sectors or in property types that are not exposed to those sorts of things. So you look at a business like storage, which has just reported a very good set of results. I mean, it's more of a business than a property company, but it does obviously have property assets underpinning the business model. Running with gearing at just 23%. Also, I mean, very strong track record. In terms of our retail exposure, it's into neighborhood and convenience. It's not into those big fashion anchored where you're relying on rents for your line shops of 800, 900, 1,000 Rand a square meter. You're looking at average rent per square meter of around 100 Rand a square meter, which is affordable for the tenant. And I concur with what Pitt's saying around the sort of general view of listed property, and the reason why we haven't made radical changes to our portfolio recently is because we haven't seen enough change in the sector, in those big heavyweights, the ones that are, I mean, Redefine still hasn't paid a dividend yet, and this is almost 2 years now. And I mean, they're talking about maybe paying a dividend towards the end of the year, but they're having to sell all of their crown jewels in order to raise the capital that they need in order to keep their business going and maybe pay a dividend. But we are certainly seeing a lot more discipline in those businesses that can do it without the pressure of 50% loan to value ratios. We are starting to definitely see some more discipline. I think the guys have learned. The market certainly is telling them their share prices reflect the view of the market, and the market is, you guys need to sort yourselves out. You need to show that you can allocate capital before we will give you more capital.
Absolutely.
And the big shareholders have been very clear about that.
Thanks, Ian. Yeah, that's exactly. I kind of wanted to elaborate on not owning the sector as well, and having very specific companies within the property sector. So that was you've got a way better way with words than I do. Yeah. So thanks for that, Ian.
I mean, the yield on the listed property sector today is now lower than the yield on government bonds, which has always been a sort of a nervy place for me. But again, when we are constructing our portfolios, the yield we're getting is still around 12 to 14%, versus the market at 8 and maybe 8, because we still don't know if some of those bigger companies are going to pay their dividends. But the sort of the bulk of the businesses that we own are, and I think maybe it's also worthwhile. I mean, especially amongst some of the smaller listed property companies, the negativity towards these businesses was way overdone. And so when they do report better earnings, there's a substantial improvement in the price. And I think, you know, no business represents that more so than Dipula. A very good management team, very conservative management team. But at one point, the B shares were trading at 90 cents, which represented, well, today represents a dividend yield of 100%. So you had a 100% dividend yielder. They will pay a 90 cent, or likely to pay a 90 cent dividend this year. You could have bought it at 90 cents in March last year, and today it's trading at R3.60. So that's just some, you know, those are just some of the opportunities. They're not all like that, but it does show you that within some of these smaller companies, and they are less liquid, and we do need to bear that in mind, there are still significant opportunities. There's still one or two others that we see.
That ties in with what's happening with the broader market, and small caps are very, very cheap. Not only small cap property companies, but small caps generally. Anything that has to do with the SA economy remains extremely cheap, and I think there are significant investment opportunities in that sector, both in property and in industrial and other small cap companies. And by the way, they've been outperforming now for 6 months, and we think that outperformance will continue.
Correct. And it's important, again, you know, the reason why we can own those smaller companies is because we are a smaller manager. I mean, it was one of the things that we set out right early on when we started Bridge, was to limit the size of any of our portfolios, particularly those portfolios that had listed property, because we always wanted to be able to take advantage of opportunities across the market, not just only owning the big listed property companies. It wasn't because we wanted to own listed property or we wanted to own equities or big equities. It's because we wanted to be able to find the best opportunities, obviously within the criteria that we set, dividends and dividend growth, but it was not to limit our investment universe in terms of size and liquidity. And as a smaller business, we can take advantage of these opportunities today.
Fantastic. I think that was a very, very thorough answer to the question. So thanks for that, Ian and Piet. I see that we're not getting too many questions from the crowd. Maybe it's because I'm putting the names up front. Maybe I should ask, if you want to post a question, you can ask to be named or left anonymously. I'll be happy to leave it like that. And so I'll refrain from calling out the names as we go along from here. So just to give the guys a chance to take a sip of coffee or water quickly, I'm going to do the next poll, which is going to lead us into the next question. So if you don't mind, I'm going to launch that right away. If you don't mind just giving us your view. There we go.
Nice, Yaku.
Yaku, you forgot none of the above. Wasn't that an option?
I was thinking, I didn't want to give them the option, so I did have it on my original list. But I'm not going to give them an out. It can't be that easy. Okay, excellent. I see more than 50% have voted already. I just want to give it another 10 or 15 seconds or so. It's slowing down, so let's share and let's see. That's quite an even split. It's 32% payers and growers, 38 value, 20% quality, and there's some. Just say that again.
I said they're being very kind to Ian and myself here.
Yeah, it's because we got no quality representatives, so that's why it came out so low.
just say thank you, and
thanks. And move on.
So that kind of leads us.
I don't know if I should be offended.
We've got some work to do, Ryan. So it's going to lead me into the next question. I'll refrain from pointing out the name. And the question was very much directed at Piet. And we spoke about in previous presentations and webinars about the style rotation taking place in the market. And the question specifically relates to, if we're entering a new value cycle, and what would be the first signs of the value stock run cooling down if it is to be a new cycle? So, Pete, if you don't mind, I don't know if the question, if I explained it properly. If not, please ask.
Yeah. So I guess the way to look at value versus growth is to look at the relative valuation of value versus growth. Is value cheap or expensive? Or is growth cheap or expensive? And even now, value is as cheap as it ever has been relative to growth. You know, even with the rebound we've had in value over the past few months, value is still, in absolute terms, the cheapest it has ever been against growth. So I think the cycle still has legs to run. One has to remember these cycles last for a lot longer than you think they do, because the market takes quite a while to get on board and get behind it. If you just rewind to the global financial crisis in 2008, at that stage, I think everyone called themselves value investors. There was no such thing as a growth investor in 2008, 2009. Everyone was a value investor. And since then, with interest rates at very low levels and growth having done fantastically well for 12 years, today, if you think about the sort of the fund managers who are up in the highlights and are, you know, attracting all the money, they are growth investors. Almost nobody wants to call themselves a value investor today. So I think the wheel has turned full circle, but I think that it started turning the other way again now. And these things always happen against the background of, you know, what's happening in global economies. So 12 years ago, we had the global financial crisis. At that time, central banks took interest rates down to negligible, just about zero levels. Economies stalled. There was very little growth around for the past 12 years. So if you were a company that could grow in that environment, you were handsomely rewarded in terms of the multiple the market put in your earnings. So you had high growth in earnings and the market increased the multiple which you put on those earnings, which led to fantastic outcomes for growth stocks. They did really, really well. I think that the whole backdrop is busy changing now, given the fact that debt levels are massively high globally. I think that the monetary authorities will be superseded by what the fiscal authorities will be doing, as we started seeing in the US, where, you know, stimulus is the thing and fiscal spending is the thing. So I think they will, you know, they will try to create inflation, because that's the only way you can reduce debt to GDP levels, is through inflating GDP in nominal terms. So if that's true, that means that growth is more ubiquitous. It's all over, and even companies on P's of 3 or 4 or 5 will be able to grow because of inflation, not because they're good businesses, but just because inflation creates a tailwind for them to grow. So I think that premium that has been placed on growth companies with the backdrop of low growth and low interest rates, I think that might be changing. So I think this, and if that's true, then it still has years and years to run. It's not gonna stop today or tomorrow. Having said that, you know, value isn't going to outperform growth in a straight line upwards. It's going to be an up and down story. There will be periods where growth makes a bit of a comeback. But I think if one bears the background in mind, in other words, what are the fiscal monetary authorities trying to engender? What are they trying to do? I think that should guide your actions. And I think what's happening now is very favorable towards value investing, longer term.
I think that's a very thorough answer. Thank you, Pete.
Yeah. Maybe just to elaborate on that, I think one of the reasons why we've seen such a strong surge in sort of the SA Inc. names that we own within the Payers and Growers portfolio, it's because their earnings have grown substantially more than the market had anticipated. So they are traditionally would be considered value stocks. A lot of them are traditionally considered value stocks, but they are now delivering earnings growth that is not too dissimilar to what your traditional growth companies have given you. And it's, you know, obviously coming off a very low base, but the fact that you do have more growth out there, you know, particularly consumers in South Africa have been spending. I mean, the comment from Liberty 2 Degrees just recently from the CEO, Amelia Beattie, that they had the highest level of footfalls and activity in Sandton City in March ever. So they've gone back and looked at every March previously in Sandton City's history, and this March was the best month of March they've ever had. Now that's just pent-up demand suddenly making its way into the economy, and the stocks that are benefiting, or the businesses that are benefiting, are the ones that are mostly sitting in that value bucket. Businesses that were neglected last year because nobody was buying their product last year. Nobody could buy their product last year. They were either closed, or people couldn't get to the stores or didn't want to go to the stores. And all of that pent-up demand is creating strong revenue growth, strong earnings growth, very strong cash flow growth, because not only are these businesses growing their top line, but they've also done a very good job of managing their costs as well. And the combination of all these things is creating an appetite for these businesses today. And therefore, it's not surprising when you see stocks in that value bucket react like they do to a positive earnings surprise, where the share price goes up 30% or 35% in a month. And I think that's really what we're seeing. And it's even more so, as Peter's mentioned already, in those smaller companies as well, because they're the ones that are really shooting the lights out from an earnings perspective.
On top of that, I think one has to bear in mind that investors globally and locally are very much under invested in value type stocks. So at the margin, there's potentially huge buying demand for these companies as people rotate out of underperformers like Naspers into stocks that are doing really, really well. And if you think Naspers prices makes up 25-30% of the index, there's huge latent demand for value stocks that still needs to be fulfilled over time.
I definitely agree with those sentiments. Absolutely. And it does answer one of the questions that came through as well. So I'm certainly glad we touched on that. At the risk of running out of time, I'm going to share the last poll that we've got. This is more for the Counterpoint distribution team, so I'm not going to run it for too long before we get into, hopefully we've got time for 2 more questions. But I certainly want this feedback for the distribution team going forward in our communication with you. So please do take time to share your view in regards to how we can roll out smaller sessions going forward. It certainly is important. It's one thing doing a webinar, but we certainly want to be able to, not necessarily sit in the same room. I know not everybody's going to be comfortable, especially with the COVID numbers picking up. We know that they've picked up significantly. Pitt has actually recovering, and we're thankful that Pitt was healthy enough to join us for today's session. And so we certainly are not unaware of COVID. We certainly are aware, but we do need that kind of feedback as well. Excellent. Right, now I'm going to close that. No need to share. Right, so let's get into the, I think we did touch on the, Ian, I don't know if there's any other comments that you would like to share on dividend payments from has there been any surprises most recently in the property space on the up or the downside?
Yeah, I think by and large, the surprises across the board, I'm not just talking about property, I'm also talking about equities, have been positive surprises, and that's because of the strong cash flow generation. So this is a trend that we saw towards the end of the first quarter when we got that special dividend announcement from AVI. The fact that companies like Tapula had resumed their dividend payments, and we've just seen that continue. There are still 1 or 2 businesses, a couple of the banks that aren't paying dividends. They clearly want to still continue to strengthen their balance sheets. They may still have some liquidity issues. So ABSA hasn't paid a dividend yet. And then 1 or 2 of the retailers are shoring up their balance sheets, like Fushini didn't pay us a dividend. That wasn't a surprise. We did anticipate that, but I think there was a small risk that we could have got a little dividend from them. They were acquisitive throughout last year, so their balance sheet is probably a little bit more stretched. And I think, given the fact that they didn't trade in April last year and probably traded very badly in May last year, that's fresh in their memories. I don't think they want to be running into another wave or another series of lockdowns without a strong balance sheet, because I think for retailers that's critical, or bricks and mortar retailers anyway, it's critical for the next 3 to 5 years to have a strong balance sheet. If you need to be flexible and adjust to the changing market, if you need to add to your online or technology presence, you need to have capital in reserve, and I think that's what Foschini Group is doing. But otherwise, it's been far more positive than negative.
That certainly is good news. We're short and get some good news. I think we'll take every little bit we can get. Rayan, I've got a question from Andrew for you, and I'll quote it as is. The question was, and I think you did touch on it briefly as well, was, will the velocity of money decrease sufficiently to counter the excessive money supply to avoid inflation? I know we briefly touched on inflation. If you feel that we've covered that sufficiently, we can move on. I do want to give you an opportunity to answer that question specifically.
Okay, sure. So I do think we've touched on it very briefly, yeah. And when the US has been pumping new dollars into the system, I mean, since 1995. I mean, I choose 1995 as a peak because that's exactly where velocity of money peaked in the US. Since then, there has been a steady decline of velocity of money, and as you can see, with a fivefold increase in dollars and decrease in velocity of money thus far, there hasn't been a significant upside print to inflation in the US. So my gut feeling tells me that trend is probably going to continue, and people won't continue to spend as much to go and drive inflation up. Yeah, I think that's it.
That's perfect. Thanks for that, round. Then on the various styles, we've got a question from Mr. Furi. I see he's been active on the Q&A box. I think this is going to be the last question, and maybe if you guys can all three share your thoughts, I think we can kind of end the session with that. The question was around blending different investment styles. You know, from a diversification point of view, how would investors benefit from blending various styles, be it from a risk management point of view, or you know, another way of looking at it, and how it was posted on the Q&A box was let me just get to it again. You know, from a core satellite point of view, do you guys have an opinion on, you know, how you would go about, you know, what percentage do you feel is a sensible allocation, or what do you use as a core? Do you use it as a satellite? I know in our previous lives before we joined the Counterpoint team, we spent quite a bit of time with the payers and growers philosophy and trying to blend that into, you know, more peer relative portfolios, and having many conversations on what is a sensible blend. There are many various ways of how one can go about, you know, blending that. Ian, I don't know if we can start off with you. Maybe do you have an opinion on what is a good way, what is a sensible allocation, or do you go 100% payers and growers when allocating capital to the portfolios?
Yeah. No, so look, I think it's all going to be dependent on your client ultimately. So you know, it's not I don't think it's a one size fits all. I mean, if I just think about the different styles within our own boutique, you know, I look at the sort of quality and the payers and growers, there's a tremendous amount of overlap. So I'm not sure how much diversification you're going to get by blending those two particular styles. However, if you look at value and payers and growers, there's very little overlap. There may be a couple of stocks that are different, that are the same, but by and large, you know, there isn't as much overlap, and so there you would actually have there would be diversification there. But again, I think it always just going to come back to the client. What does the client want? Does the client need income? Is the client saving, has a 50-year time horizon? Does the client have a 2-year time horizon? If it's 2 years, it's fixed income. You know, if it's 10 years, well, then you start to look at the other styles and blend. But I would say within our own boutique, the payers and growers and quality has overlap, and maybe value is not as much with the other two styles.
You're shaking your head.
So I do think that value is a very underutilized tool for diversification purposes. I think if you look at the fund manager landscape in South Africa, you've got a few big ones which everybody uses, and they're all the same. They all do exactly the same. And I think value is underutilized as a diversification strategy. But again, as Ian says, it depends on the client and what the client wants and what the client needs. And I think that's the financial advisor's role, is to interpret that.
Absolutely.
But I think two ways to do it. So you can either take value plus quality plus pays and grows and put all those things together, or you can take the index, and I think that's another underutilized strategy in stuff, because why would you have money with three of the big fund managers? We can just put everything in the index and then put some value and some pays and grows and some quality and some around the index to enhance the index. That's another way of doing it, which I think makes a lot of sense. So I think a lot of thought still needs to go into that. There's no easy answer. But I think more niche strategies like the strategy we have at Counterpoint make sense to build into a portfolio.
Excellent. Guys, I see we've reached 10 o'clock. Time has gone by so quickly. Thank you so much for all your contributions to today's session. We certainly having some coffee with Counterpoint, and we certainly look forward to our next session, and you will be receiving your invite shortly. Thank you. Hope you have a great day. Keep safe and keep healthy. Thank you. Bye-bye.
Thank you.
Bye-bye.
Bye-bye.
Cheers.